Hello, everyone, and welcome back to another episode of Tax Thursday brought to you by Smart Counsel. I am your host, DDQ, here with Smart Counsel's tax resident attorney, Dionne Kellier. Happy Tax
Happy
Thursday,
Tax
Dionne.
Thursday, Dee Dee. How are you?
I am doing well, and I know you are doing awesome. You're like now famous.
Something like that.
Can you tell us a little bit more about that? Like, what's
Sure,
going
no.
on?
Okay, so we record Tax Thursdays on Tuesdays of the same week. And so this morning when I was driving into work, I was listening to Sway in the Morning, which I listen to almost every morning, and I love it. And he had this Sway Chats, and it's a 60-second like plug for your business, right? So I'm listening to it. I'm one of those people, I don't win anything. I don't ever get through on the radio. And I got through. I was the second caller, and I just went like, as soon as I opened my mouth, I just like vomited Tax Thursday stuff and vomited all our little Tax Thursday, facts. And, I think it's going to be really good. I would love to be on that show. Heather B said that she is going to have me on her show. And I am just so excited because I just love spreading this tax knowledge.
Yes, definitely. I feel like it's just every topics that everyone needs to know that we do not know unless you're in a certain situation that you are forced to now
Right.
learn, under stress and different circumstances. So that's awesome that you got on the radio. I can't wait to see what comes of it. And if you are watching this because you heard Dionne on the radio, thank you so much for following us on Instagram and on our YouTube channel. You will not regret it.
Regret it. And just even how this topic came up was because of our topic last week that I didn't necessarily know there were all these forms of employee compensation. And really last week we were talking about what type of income is not taxable. So everything leads to something else. And I suspect that this topic will probably have a part 2 next week because I didn't even from the IRS's website, I barely even got halfway through.
Yeah, no, definitely. And if you did miss out on our last episode, you can catch that on our YouTube channel. Just search Smart Counsel and you will see our channel there and you'll see all of our past videos so you can kind of keep up with what is going on in our tax world and all tax topics. Also, you can visit our website at www.smart-counsel.com to learn more about our other attorneys, practice areas, and overall our firm. But like Dionne said, we are going over a new topic today, and that is the different types of employment compensation. So, Dionne, I guess my first question is, what exactly is employment compensation?
It is the short answer is like any remuneration, which is payment that you receive from your employer. So in most cases, you must include in gross income everything you receive in payment for personal services, in addition to wages, salaries, commissions, fees, and tips. This includes other forms of compensation such as fringe benefits and stock options. And you should receive a W-2 from your employer showing all of these things. And if you perform services other than an independent contractor and your employer didn't withhold Social Security or Medicare taxes, you have to file a Form 8919 and you have to pay those on their own, basically.
Okay. So it's a little different from workers' comp, I'm assuming.
Workers' comp it's a disability payment, and it is not necessarily employment compensation. And there are, we kind of talked about it last week, but if you receive payment for an injury, a physical injury, that is not taxable. And so workers' comp, I'm going to presume, is going to fall into that category. So, of course, always consult with your tax professional before making any final decisions. All right. So let's start talking about miscellaneous compensation that will be included in your taxable income. First thing, advance commissions and other earnings. So if you receive an advance on commissions or other amounts to be performed in the future, and you're a cash method taxpayer, which is all of us, everything outside of a business, everybody is a cash basis taxpayer outside of a business. Then a business gets to choose if they're going to be a cash basis or an accrual basis taxpayer. So you must include those amounts in your income in the year that you receive them. And if you repay unearned commissions or other amounts in the same year you receive them, or you reduce the amount of unearned commissions including your income by that repayment, and if you repay them in a later tax year, you're able to deduct them as a repayment as an itemized deduction on your Schedule A. Another type of miscellaneous compensation is allowances and reimbursements. So if you receive a travel, transportation, or other business expense allowance or reimbursement from your employer, then that is included in your that is considered employment compensation, and it's included in your taxable income. Also, if you're reimbursed for your moving expenses, that is included in your taxable income. If you have back pay awards, so you include in income amounts you are awarded in a settlement or judgment for back pay, and these include payments made to you for damages, unpaid life insurance premiums, and unpaid health insurance premiums. You should get a W-2. They should be on your W-2. And if they are not, and this is just a warning, if you receive some sort of compensation and it's not accounted for on your W-2 and you don't get a 1099 for it, don't think that it's not being reported. It is. Right.
Right. So is it kind of like different forms for each miscellaneous situation, or is it going to be just that one general
It'll
form?
be on your Schedule A, but as you are, like, say you were doing TurboTax, for instance, they are asking you these questions, right? They are prompting, they're like, did you receive any income from this? Did you receive any income from that? And if they don't ask you a specific income source, like say that they don't ask you, did you receive back pay for, were you awarded back pay? But you receive back pay, there is a final catch-all. Did you receive any income? And describe it, kind of. What was the amount and what is the description? And more likely than not, that is going to be something that's going to be included in your taxable income based on your description. But that will go on a Schedule A. So like when your 1040 is like a one and a half page form, but each line has a reference to either a schedule. So the number came from somewhere, right? You just don't put $100,000. That it's either going to be on a W-2
Right.
or it's going to come from one of your schedules on the tax form. So next
Okay.
thing, bonuses and awards. So a bonus or award you receive for outstanding work are included in your income and should be shown on your Form W-2. And these include prizes such as vacation trips for meeting sales goals. If the prize or award you receive is goods or services, then you must include the fair market value of the goods or services in your income. And however, if your employer merely promises to pay you a bonus or award at some time in the future, it isn't taxable until you receive it or it's made available to you. And a note that I want to talk about for fair market value. What is the fair market value of something? And so I'm gonna use the term fair market value a lot. And so what fair market value means is so the IRS definition is the fair market value of an item of property is the price at which the item would change hands between a willing buyer and a willing seller, neither being required to buy or sell, and both having reasonable knowledge of relevant facts. So it's fair market value. Also, a third arm's length transaction is another term for it. It's basically what two people that are unrelated would buy what they would pay for an item and what they would sell an item for, right? Because if you have the reason why it's unrelated, because I would probably give my sister a better price than I would give Joe Schmo walking off the road. So the IRS is going to use the Joe Schmo standard as opposed to what I would sell it to my sister for. All right.
Okay.
No
That
problem.
makes
So
sense.
then another form of compensation is an employee achievement award. And if you receive tangible personal property other than cash, a gift certificate, or an equivalent item as an award for the length of service or safety achievement, you must generally exclude its value from your income. However, the amount you exclude is limited to your employer's cost and can't be more than $1,600, and $400 for awards that aren't qualified plan awards. So basically, if you receive an employment achievement award that is in excess of $1,600, anything in excess of that $1,600 needs to be included as employment compensation. But the exclusion does not apply to the following awards. So if you have a length of service award and you received it for less than 5 years of service, or if you received another length of service award during the year or the previous 4 years, or a safety achievement award if you're a manager, administrator, clerical employee, or a professional employee, if more than 10% of eligible employees previously received the Safety Achievement Award during this year. So an example, Joe Schmo received 3 employee achievement awards during the year. a non-qualified plan award of a watch valued at $250, and 2 qualified plan awards of stereo valued at $1,000, and a set of golf clubs valued at $500. Assuming that the requirements for the qualified plan and other awards are satisfied, each award by itself would be excluded from income, but because the entire award totals $1,750, then Ben has to include $150 in his income. So the way that your employer classifies whatever he's going to give you an employment achievement award, it makes a difference. But just in your mind, if you receive anything for being a great employee, and it's in excess of $1,600, then anything in excess, just in your mind, know that you're going to include it in your taxable income.
Okay. Yeah. So just kind of keep an eye out of the total amount of that
Exactly.
whole that award from your
Right.
employee. Does the employee also put that on their taxes
So the
as well?
employer makes a taxable. So the employer would have it as an expense, right? So the employer is deducting this amount from their taxable income, and they're giving it to you, but you're able to exclude it except when it goes in excess of that $1,600. And what the employer is going to do is they're not going to give you one award that is going to be in excess of the $1,600. They may give you several different things. Some may be in a qualified plan, some may be in an unqualified plan, but for them it's each item. For you, it's the total amount.
And would that be just like a one-time award, or would it be as well like awards gathered kind of throughout the year?
It's going to be a year. So you're going to take your taxable, everything is going to be in the taxable year. So they give you the gift in January that is worth $2,000. Any other gift they're going to give you, you're going to have that 400 plus the amount of, any of the additional gifts.
Okay, that definitely makes sense.
All right. So next thing, differential wage payments. So this is any payment made by an employer to an individual for any period during which the individual is, for a period of more than 30 days, an active duty member of the uniformed services and represents all or a portion of the wages the individual would have received from the employer during that period. So basically, when somebody gets called, like the reservists, for instance, when they get called to go on whatever their duty is, then your employer still is required to either, you should not make less money just because you're gone. So your employer is still required to make payments to you, and that would be included in your taxable wages for whatever that tax year is. Government cost of living allowances. Most payments received by the U.S. government civilian employees for working abroad are taxable. However, certain costs of living are tax-free, and there's a publication, there is an IRS publication for everything. But if you are a civilian employee working abroad, your income is taxable. However, when you work in areas that are highly, like there's a lot of war, like for instance, say that you're a civilian that goes to the Ukraine, for instance, to like rebuild their infrastructure, whatever it is, there you're going to get hazard pay, and certain amounts of that are going to be excludable from your taxable income. So it's interesting, right? You're risking your life. You're making 3 times of what you would normally make, but are you going to come back? I mean, that's the bigger question, right? Like, I understand that it's a lot of money, but are you going to come back? I don't know. I think I would rather safer bet, but hey, everybody lives.
Exactly. That kind of like makes me think, like, what about our servicemen and women, like the Army, the Marines? I don't know much about that whatsoever, but don't they also get paid? And would that kind of be the same thing if they're like on duty?
So the actual pay that they get is taxable income. But then, right, well, they're not going to be civilians, so that would knock that out. Right. But the hazard pay that they get, I'm pretty sure, if not certain, that there is a mechanism that doesn't make it unpalatable, because if it was unpalatable, then people would not take these jobs and would not take these duties up. And as we see, people volunteer every single year, and as we see that contractors, they volunteer all the time to go to these different places, because I mean, if you think about it, like, you can make, like, when you go to these regions that give you the hazardous pay, you can make like 10 years worth of your salary in like 2 years, right? Depending on
Right.
what the business decides. But you can, I don't necessarily think it's a bad deal. I personally wouldn't do it, but I don't think it's a bad deal.
Mhm. Right. Exactly.
All right.
Okay.
All right. So next thing, non-qualified deferred compensation plans. So your employer will report to you the total amount of deferrals for the year under a non-qualified deferral compensation plan. That amount is not included in your income. However, if at any time during the taxable year the plan fails to meet certain requirements and it isn't operated under those requirements, all amounts deferred under the plan for the tax year and all preceding tax years are included in the income. So what that means is like a 401k plan, for instance, you have your pay, right? So say like each check you get $100, and when the taxes are deferred or they're taking out the money for the 401k plan, the tax that is calculated won't be calculated on that $100. It's going to be calculated on, say that $20 comes out to go into that 401k. You're going to get taxed on $80 because that $20 is tax deferred. It is taken off the top. And so if your plan fails to meet the IRS standards for these type of plans, then that money, that benefit that you get to not paying taxes today on that money, that's going to be eliminated until your employer, because it's going to be your employer that's in charge of keeping the plan being qualified and meeting all of the requirements. It's going to be up to your employer to fix it. And there are very, 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 very hefty fines for not being compliant with like your it's a 401k, but they are under IRS code 409A. That's the section. So 401ks,
Wow.
IRAs, they need to be compliant with 409A. And if they're not, very hefty fines, and typically the employers are responsible for it. The employees, the hit that they get is that they'll have to pay the taxes now, but like all the penalties and stuff typically falls with the employers because the employees have no control over things being compliant.
Right. Exactly. Wow. That's definitely something good to know when you're
Right.
managing all
Exactly.
of
Like I would never want to manage anyone's deferred compensation plan. I would not want that, but there are very capable people that are able to do it, and you let those capable, able people do it. That's my piece of advice on that. Um, Let's see,
exactly.
non-qualified deferred compensation plans of non-qualified entities. So in most cases, any compensation deferred under a non-qualified deferred compensation plan of a non-qualified entity is included in the gross income when there is no substantial risk of forfeiture of the rights to such compensation. So for this purpose, a non-qualified entity is one of the following: a foreign corporation, unless substantially all of its income is effectively connected with the conduct of a trade or business in the United States, and or it's subject to a comprehensive foreign income tax, or a partnership unless substantially all of its income is allocated to persons other than foreign persons or tax-exempt organizations. So basically a non-qualified entity is going to be a foreign corporation or a partnership, but everybody's detail or everything is fact specific. So just listening to me right now, like, don't make the decision of like, oh my God, I'm a non-qualified entity. Reach out
Right.
and let's go through your whole situation, and then we'll determine, are you a non-qualified entity and does this apply to you? All right. So another form of employment compensation is a note received for services. So if your employer gives you a secured note as a payment for your services, you must include the fair market value, it's usually a discounted value, of the note in your income for the year you receive it. And when you later receive payments on the note, a proportionate part of each payment is a recovery of the fair market value that you previously included in your income. And you don't have to include that part in your income again. You just have to include the rest of the payment in your income in the year of payment. That's like an installment payment, basically. So like I gave you services, but you couldn't pay me at that time. So we decided that, you know what, for the value of my services, which we use the fair market to determine the value, then you can pay it in like every 3 months, every year, whatever the number is. And if your employer gives you a non-negotiable unsecured note as payment for your services, payments on the note that are credited towards the principal amount of the note or compensation income when you receive it. So basically, if I gave you services valued at $100, but you didn't have the $100 right now I'm at $0 and you owe me $100, right? Then when you start paying me, say you pay me $10 over every year for 10 years. So when I get the $10 in this year, I include that $10 in my taxable income, and you, the business, you're taking that $100 benefit that you got and you're netting it out. So when you pay me $10, now you have a $90 benefit and I have a $10 benefit. And then when you pay me another $10, you have an $80 benefit, and then I have a $20 benefit. And then basically it's going to get to the point where you're going to have a $0 benefit and I'm going to have the $100 benefit. Make sense?
Interesting. Yeah.
Typically people don't utilize notes for services, but I can see why you would, right? Yeah. It's going to be a close relationship, and the person didn't have the money to pay you, but your services have a value to it. So.
Yeah, definitely.
All right. Next, severance pay. You must include in income amounts you received as severance pay and any payment for cancellation of your employment contract. Let's see. Severance payments are subject to Social Security and Medicare taxes. Next thing, accrued leave payment. So if you're a federal employee and you receive a lump sum payment for accrued annual leave when you retire or resign, this amount will be included as wages on your Form W-2. If you resign from one agency and are reemployed by another agency, you may have to repay part of your lump sum annual leave to the second agency, and you can reduce your wages by that. Let's see, outplacement services. If you choose to accept a reduced amount of severance pay so that you can receive outplacement services such as training in resume writing or interview techniques, you have to include that unreduced amount of severance pay and income. Sick pay will be included in income. So pay you receive from your employer while you're sick or injured is part of your salary or wages, and in addition, you must include in your income sick pay benefits received from any of the following payers: a welfare fund, a state sickness or disability fund, an association of employers and employees, an insurance company if your employer paid for the plan. However, if you paid plan premiums on accident or health insurance, the benefits you receive under that policy is not taxable. So just because you may fall under one of these categories, it's always very important to flesh out the details so we can actually determine, like, are you actually one of the people that they are saying needs to include the sick pay? Because you may not be, because you may have paid premiums. Let's see, Social Security and Medicare taxes. If you and your employer have an agreement that your employer pays your Social Security and Medicare taxes without deducting them from your gross wages, you have to report that amount as income received to you. Right? You cannot, there are different, so the IRS has seen every scheme, right? So whatever it is that you think you're going to come up with to avoid paying taxes, like, oh, you can just, instead of paying it to me, you can pay them to my child. Okay, that's fine. That's still going to be included in your taxable income, and you still will be responsible to the IRS.
Okay, yeah. People always try to get around that. And it's like they've been there, done that.
It's almost like, I like to give this example. You know, like if you have like a child that is like, yeah, my mommy said I can eat ice cream for dinner, and you see their little eyes going and everything. You're like, oh, okay, did your mom say that? That's great. Like, that's how the IRS feels when you're trying to do your elaborate scheme. They've almost seen it all. And if they haven't seen it, they've seen some form of it. And if you are their first impression, then I think it might be a really bad thing for you, right? Because then you're going to pique their interest, like, whoa, wait a minute, how did you figure this out? So, like, everything you've done in your life is probably going to be scrutinized if you are the IRS's first impression of whatever the issue is.
Yeah. They know those red flags from afar.
Exactly.
So it's very hard.
Let's see what else. Okay, so accrued leave payment, we talked about outplacement services. Oh, wait, I just talked about that one. Let's see. Stock appreciation rights. You do not include don't include a stock appreciation right granted by your employer in your income until you use it or exercise it. When you use the right, you're entitled to a cash payment equal to the fair market value of the corporation's stock on the date of use minus the fair market value on the date that it was granted, and you include the cash payment and income in the year you use the right. Virtual currency. If your employer gives you virtual currency, such as Bitcoin, as payment for your services, you must include that fair market value in your income. And the fair market value of virtual currency paid as wages is subject to every other tax that any regular non-virtual currency would be subjected to. So that is that miscellaneous income, that is one form of employment compensation that is not necessarily talked about. Next thing we're going to talk about, which is, you had a question, I'm sorry.
Okay. Oh, no, go ahead.
All right, so the next one that people really don't talk about, but there are so many people that violate including fringe benefits in their taxable income, because I think that they think that, this is free money. There's never any free money, just so you know. So first thing, fringe benefits received in connection with the performance of your services are included in your income as compensation unless you pay fair market value for them or they're specifically excluded by law. And refraining from the performance of services, for example, under a covenant not to compete, is treated as the performance of services for the purposes of those rules. So if you have a covenant not to compete and you receive money to actually abide by that, that is compensation. Although I personally have not seen someone get paid to not compete, but just because I haven't seen it doesn't mean it doesn't happen.
To not compete exactly what?
When you have a business, right, and you have trade secrets and you make the employee or the independent contractor, as part of accepting your employment or accept the position, sign a covenant not to compete. Those things are, so they are enforceable to a certain extent. They have to have a good, if you're saying, oh, you can't compete in the entire United States, that is going to be voided by the judge. So you don't even, that you need to have, your radius could be probably a 50-mile radius, probably more like a 25-mile radius. And then if you're oh, you can't compete in the United States for 10 years, that 10-year period, that United States, that's not going to work. You have to be reasonable. You can't have somebody be destitute out here just because you feel like they're competition.
Right. Okay, that makes sense.
So, okay. So for fringe benefits, we'll probably get halfway through it, and then we'll continue this next week. So the recipient of the fringe benefit. You are the recipient of a fringe benefit if you perform the services for which the fringe benefit is provided. You're considered to be the recipient even if it's given to another person, such as a member of your family. An example is a car your employer gives to your spouse for services you perform. The car is considered to have been provided to you and not to your spouse. But if you're married, filing jointly, it really doesn't matter because everything is going to be pooled together. And you don't have to be an employee of the provider to be a recipient of the fringe benefit. If you're a partner, a director, or independent contractor, you can also be the recipient of a fringe benefit. And the provider of the benefit, you're the employer or another person for whom you perform services, is the provider of a fringe benefit, regardless of whether that person actually provides the fringe benefit to you. And the provider can also be a client or customer of the independent contractor. The accounting period. You must use the same accounting period your employer uses to report the taxable non-cash fringe benefits. Your employer has the option to report taxable non-cash fringe benefits the non-taxable fringe benefits by using the following rules. The general rule is the benefits are, it's either that, it depends. So whatever taxable year the provider uses, you use. So they can either use a full calendar year, they can do a special accounting period. And so that really depends on on what the business uses and what type of business it is, because if it's a business that's only operates from June to August, right, like one of those water parks, then that is the accounting year that they use. But just as a taxpayer, you use a calendar taxable year, period. You're able to explain why you're using a calendar taxable year. That's just the long and short of that. And it has to be included on your W-2. So what is a fringe benefit? I think we'll just talk about, we're going to talk about I'm going to tell you what some of them are, and then next week we'll go into the details of what fringe benefits are, because there's like so many of them, and I
Okay.
want to give them each their own, I want to talk about each of them. So what's considered a fringe
Yeah.
benefit? An accident or a health plan, long-term care coverage, Archer MSA contribution, HSA, so a health flexible spending arrangement, a health reimbursement arrangement, a health savings account. What else? Adoption assistance, athletic facilities, a de minimis benefit, holiday gifts, dependent care benefits, educational assistance, employee discounts, financial counseling fees, employer provided group term life insurance, permanent benefits, accidental health benefits. What else? Meals and lodging, faculty lodging, academic health center, qualified campus lodging, adequate rent. So if you get rent, if your employer provides rental payment, that's considered a fringe benefit. So while it's not compensation being paid to you for services, it is like, say that when you move to a different city for your job, they pay for your apartment. They pay 50% of your apartment, or they'll pay $2,100 a month. That is a fringe benefit. Moving expense reimbursements, although that's a little tricky now because with tax reform, if you're a W-2 employee, they don't necessarily pay for those, but we'll talk about that next week. Let's see. Retirement planning services, transportation. So if your employer, like if they give you a transit pass, if they give you parking, a parking pass, whatever, let's see what else. And tuition reduction or working condition benefits. These are all considered fringe benefits. And the valuation, if a fringe benefit is included in your income, it's typically valued at fair market value. And we'll talk about all of those things next week. I just kind of wanted to give you we'll probably spend all next week on fringe benefits, right? Because there are so many. And so we can talk about it a little more. And if you have any questions in the interim, you can send them. If there's anything specifically that you would like for me to talk about or discuss, I will see it. And so, but just know I prepare Tax Thursdays on Tuesdays. So yeah.
So send it to us as early as you can. But I think like out of everything that you named under that category, at least each of us, watching this have like one or two that we can, relate to or may have questions on because we are, I guess benefiting or, have our hand in it somehow. So that'll be a very interesting topic for next week.
I'm excited too. I'm excited. I love this tax stuff, but I am excited to I'll probably give some examples and just things that you never even thought about. And I will say this, if you're listening to me and you're like, oh my God, I've never included any of these in my income ever, right?
Yeah.
Don't worry. Calm down. We can discuss it and we go from there. And that's it.
Yes, perfect. Yeah. Send us your question, guys. DM us on Instagram at Tax Thursdays, or you can email us directly at attorneys@smart-counsel.com. We will get to you. We are very quick in responding. We'll get you on the phone with Dionne or just respond right then and there. But yeah, send us your questions for next week's topic. That'll be a very interesting topic, like we said. But thank you so much again for your time, Dionne, for today's topic. It was a lot of information. I think we can all kind of just simmer on it while we wait for next Tax Thursday. What would you say are our takeaways before we do go from here?
Anything that you receive, any remuneration, remuneration, whether it's money, whether it's property, whether it's a dinner, whether it's a gift card, whatever it is that you receive from your employer, whether you are a W-2 employee or independent contractor, may be considered income. So just dig a little deeper to find out if it is something that is includable in your taxable income for that year. And if it is included, and if it's not, then, mention it. That's the best thing. If it is included, if it's not, mention it so the IRS can be like, oh, wait a minute, you don't have to include this. And you just want, you don't want to get audited ever.
Right. Better safe than sorry. And I think out of every Tax Thursday, it's just like keep records of everything that,
Absolutely.
you're getting from people or from your employer, especially. Keep good track records so then you can produce those receipts when the time comes.
Absolutely. Receipts are your best friend.
Right. Awesome. Well, thank you again, Dionne. And thank you, everyone, for watching another episode of Tax Thursday. Make sure to follow us on all of our social media platforms and to like and subscribe to our channel. We will see you guys next week with a new topic and a new episode of Tax Thursday. So
Bye.
thanks,
Have a good
Dionne.
day.
You too.